We'll start with some introductions. I'll share some comments about the income property exchange and specifically about Delaware statutory trusts. Our guest speaker, Patty Flowers, will provide a more detailed perspective on the 1031 exchanges, and we'll go over some questions at the end of our prepared comments. So, a little bit about us. We believe in changing the landscape of financial and investment and retirement planning begins with a more educated and informed client. For over 3 decades, our firm, Charles River Financial, has helped individuals, organizations, and investment stewards make informed decisions regarding their wealth and finances. As an independent organization, we're driven to provide objective advice and solutions through an experienced team in a disciplined process. Our featured speaker today is Patty Flowers, who is a certified exchange specialist and a vice president of Investment Property Exchange Services, or IPX. IPX is the largest qualified intermediary, or QI, in the country and part of the Fidelity National Financial Company, a family of companies, which is a Fortune 500 company and trades on the New York Stock Exchange. Patty is invaluable to both investors as well as members of the tax, legal, investment, and real estate community to guide them through the 1031 exchange process. And I just wanted to, before I advance, share a few comments about the importance of a qualified intermediary, or QI, sometimes known as an accommodator or facilitator. Choosing the right provider is key to executing successful transactions. In order to complete a 1031 exchange, an investor must not take constructive receipt of the proceeds of the sale of the relinquished property. A QI is an entity, whether a person or company, who acts to facilitate the 1031 exchange by entering into a contractual agreement for the exchange of properties, avoiding constructive receipt. Neither the taxpayer nor a disqualified person may serve as a QI. The 1031 exchange QI is responsible for preparing the 1031 exchange legal agreements and related transaction documents in order to properly structure the transaction, also receiving, holding, and safeguarding the 1031 exchange fund throughout the transition, and advising, coordinating, and consulting on the implementation of the 1031 exchange to ensure compliance with the IRS. So why is this so important for individual investors? Well, commercial real estate or income property represents a meaningful portion of a high net worth investor's holdings. And in this example on the slide, high net worth is defined as individuals with more than $1 million in liquid financial assets. And this chart shows comparison between 2016 and 2017, where 58% of high net worth individuals having more than 10% of assets allocated towards commercial real estate. And of that, 79% of those held it directly in direct ownership of real estate. I wanted to talk through this decision tree, and I'm going to start at the top of the screen here when someone decides to sell an investment property. There's really a couple of paths you can go down. So off to the left, someone can choose to sell the property outright, pay the taxes, which include federal capital gains, state capital gains, and it varies state by state. In Massachusetts, it's 5.1%. Depreciation recapture, which is 25%, and net investment income tax at 3.8%. However, if they decide to exchange the property on the right side, where the green arrow is, that's when you need to engage a qualified intermediary, and you really have 2 paths you can go down on an exchange. One is either hands-on and what I'll call active real estate, where you're buying a property with management. The reference to terrible T's is the tenants, termites, trash. You're subject to getting your financing in place, and also finding the right property within the limits that Patty will talk about. The other avenue, which a lot of folks are not as familiar with under the 1031 rules, is the Delaware statutory trust, which we'll talk about in a moment. And what I wanted to add to this slide is it's not an either or. So you may choose to exchange part of the sale. You may choose to exchange all of it. You may want to break that up into physical property and maybe a DST. We've had instances where a client sold a property for $10 million, identified and bought a new property for $8 million, and they would have created a scenario called boot, which Patty will talk about, with the excess. And in some cases, the DST, or Delaware Statutory Trust, works nicely in that scenario. To enter into a Delaware Statutory Trust, or DST, you have to be an accredited investor, which means you have to have a net worth in excess of $1 million, which does not include your primary residence, or have $200,000 as an individual in each of the last 2 years from an income standpoint, or $300,000 in the last 2 years if you file a joint return with your spouse. Here's some basic steps, and again, Patty will go into the weeds a little bit deeper. But first, the exchanger, or the property owner, sells the property, and the proceeds are escrowed with the qualified intermediary. The qualified intermediary transfers funds for purchase of the replacement property or properties. In exchange, that involves an investment with a Delaware Statutory Trust. The exchanger would receive a beneficial interest in the DST. So 1031 exchange allow you to sell your real estate income property, reinvest the proceeds in like-kind real estate, and defer the payment of taxes on that sale. The IRS defines like-kind as property that is similar in nature or character, regardless of the differences in grade, property type, or quality. For investors, a 1031 exchange offers a range of potential benefits, such as tax deferrals, diversification, tax advantages, cash flow, or wealth preservation. The securitized 1031 industry, mainly through the use of DSTs, and in some cases TICs, or tenants in common, now exceeds over $2 billion annually. This slide shows some of the more popular types of properties being used in DST. A DST is a professionally managed and typically contains multiple income-producing commercial properties. Investors receive their prorated share of the income, tax benefits, and capital appreciation produced by the real estate without management responsibilities. The DST holds title to the properties, while multiple investors own a beneficial interest in the DST. For tax purposes, each DST investor is treated as owning an undivided fractional interest in real estate. IRS Revenue 2004-86 provides guidance on the use of DSTs for property ownership. So the DST marketplace, securitized 1031s, DSTs are structured as securities and sold through the broker-dealer community. A broker-dealer must have a selling agreement in place with the sponsor, and the registered representative must either hold a Series 7 or Series 22 license, in addition to further education and training on each program. And I included on this slide the list of some of the top providers in the marketplace in 2017 by market share and also by the property types. So agreements with these sponsors is not enough. You need to work with a knowledgeable, experienced sponsor and independent broker-dealer representative to provide rigorous due diligence and thorough review of each offering. Generally, there are three types of broker-dealers in this space. One that first I would say limits selling agreements only to one or two sponsors. A second group having selling agreements with all the sponsors and providing little review. And the approach that we take, as a third approach, would include access to a good supply of thoroughly reviewed programs put through a consistent due diligence process. I mentioned in 2017 there was approximately $2 billion in equity raised through securitized 1031s. Our broker-dealer, Concord Investment Services, represented nearly $250 million of those transactions, putting us in the top, if not the top, broker-dealer in the DST marketplace. According to a study by Mountain Dell Consulting in 2017, there are 27 sponsors raising equity through 102 offerings comprised of 85 registered products and 17 506C offerings. The vast majority of those were under the Delaware Statutory Trust structure, while less than 3% were under a tenant in common, which was a more popular structure during the mid-2000s. So the benefits of a DST, I'll just run through a couple of these rather quickly. So tax deferral, it's all about deferring federal and state taxes on the sale of investment property. Tax forgiveness, the heirs of an investor receive a step-up tax basis on death So the heirs can sell without taxation, converting deferral of taxation under Section 1031 into complete tax forgiveness. Acquiring higher quality investment grade replacement properties. The DST structure permits a small investor to acquire higher quality replacement property than they may be able to afford on their own. Diversifying to reduce risk. DSTs have a low minimum investment amount. Investors can acquire a number of DST replacement properties, allowing further diversification, reducing concentration in any single property. And we've seen some of the sponsors offer positions as low as $25,000. Hassle-free investing, the sponsor does all the work. The sponsor sources the property, conducts the due diligence, negotiates the loan, closes the purchase, manages the property, and sells the property at the end of the holding period. The sponsor provides quarterly reports and an annual tax package. DSTs are passive income, freeing investors from the hassles of direct property management. The last few items, DST produce mailbox money. DST distributions are paid monthly or quarterly, depending upon the program, to investors by direct deposit into their bank account. And the last two, liability protection. The DST structure protects each investor from liabilities associated with the property. And debt replacement, if you're selling a property and you want to have matching debt, which I think Patty will go through some examples, the sponsor sources debt needed by most investors to complete their 1031 exchange, and the debt in a DST is non-recourse, so investors are not obligated to repay that debt. The last example here, sometimes folks get exchanged when we reference step-up in basis. So whether you own a physical piece of property or you own participation in a DST, upon the death of that owner, their heirs would get a full step-up in basis and be able to avoid the tax altogether. At this point, I'm going to turn it over to Patty and take us a little bit deeper.
Thank you so much. So I'm Patty Flowers, Investment Property Exchange. We're the largest qualified intermediary in the country, and our job is to make sure that your 1031 exchange goes smoothly and correctly, so when it comes to tax time, everything can be reported and passes muster with the IRS. So a 1031 exchange itself, also called a tax-deferred exchange, the tax code section really says that no gain or loss shall be recognized on the exchange of real property as long as it's held for productive use in a trade or business or for investment purposes. And you do an exchange to purchase new investment property that's also held for productive use in a trade or business or for investment. I think the real key is here when people will call and say, hey, I want to do a tax-free thing, you want to remember that it may be tax-free down the road, as Kent mentioned, for the heirs with a stepped-up basis, or in a few other scenarios. However, in the year that you do the 1031 exchange, is actually a tax deferral. You're deferring any taxes due on the gains to a further date, a further year down the road. The main portion of the tax code, the new tax act that came into play on January 1st of this year that had to do with 1031 was real property versus personal property. So as of January 1st, anything that has to be sold that's considered personal property, equipment, furniture fixtures, franchise rights, artwork, the list goes on. Anything that's considered personal property can no longer be done as part of a 1031 exchange. So anything that had sold in 2017 under personal property, they are allowed to finish their exchange in 2018 if need be. But starting January 1st, you can only do a 1031 exchange to defer the taxes on real property. So really, what are we deferring when you do a 1031 exchange? So in the exchange, there are several taxes that are due. You work with your tax advisor to calculate what your gain would be upon sale. That gain is still recognized by the IRS at tax time, just maybe not realized depending on how you do your exchange to the full extent or partial. So in the exchange, we're deferring the federal capital gains tax, which could be 15 or 20%, depending on the income bracket you're in. You're also federally declaring the 3.8 healthcare tax that came into effect in 2013. You're also deferring the gain due to depreciation. So that depreciation recapture at 25% can also be deferred with a 1031 exchange. And then certainly, as we mentioned earlier, any state capital gains taxes are deferred with a 1031 as well. So it really could be that if you were selling a property outright, you would talk to your tax advisor, what am I going to pay in taxes if I sell this outright? What's my gain? And then if you decide, well, if I do a 1031 exchange and I follow all the rules and go through everything completely, I could actually pay zero in taxes.
So Patty, let's maybe talk through just an example. I guess I want to set the stage a little bit. So for this example, we're going to ignore closing costs such as attorney's fees, tax stamps, broker's commissions. We're also in this scenario assuming a fully depreciated example, which was not itemized here. And we make reference to the Medicare tax, which again is the net investment income tax, sometimes known as the healthcare tax you referenced. And lastly, in this example, for the state tax purposes, we went to the taxfoundation.org for kind of a national average, so we're using 6.1% example. Again, for those on the line with us in Massachusetts, that would be 5.1 on a localized basis. So in this example, we're selling the property, again, ignoring closing costs, sale price of $1 million. Original cost basis was $100,000 plus any improvements in this example. It was fully depreciated, so we're realizing a gain of $100,000 because of that depreciation. So as Patty mentioned, we're capturing back 25% of that. We depreciated our original base of 25%. Our federal capital gains is on the differential here, $900,000, $180,000. State capital gains using a 6.1 is on the full amount because the Fed distinguished between depreciation recapture, the federal capital gain, and then this Medicare health surcharge. So all in all, in this example, this example would face in excess of a 30% tax, but with an exchange could defer or possibly avoid if there is a step up involved, all of that.
And that is a significant savings, certainly. And I think a lot of people, when they first talk to their accountant or know a little bit about what the tax laws are, they say, oh, it's just going to be 15% or 20%. They don't really take into consideration those other taxes that are due a lot of times. So you want to really be able to either give your client, if you're an advisor, give them the full picture of all the taxes, or if you're an investor, you want to be sure you're asking all those questions. What are all the taxes due on a sale? So right now what I'm going to do is I'm just going to backtrack a little bit and walk through some of the basics in a 1031 exchange. There's a lot about what we talk about in the first conversations or meetings with clients regarding an exchange. So like-kind property is the term that they use in the tax code. It's actually very misleading. So like-kind does not mean you have to buy the same exact type of property that you sold. Like-kind actually means that excuse me. Like-kind actually means that the property that you used was used for business or investment purposes, and you're going to exchange it for other property that is also business or investment purposes. So really, in a 1031 exchange, you could be selling retail, apartments, single-family rentals, multifamilies, in common, raw land is considered investment for 1031 exchange, and you could go on and buy one or any of those types of properties on the other side. You could sell an apartment building or a multifamily, and you could go into retail. You could sell raw land and buy something that's getting income automatically as soon as you purchase it. You can mix and match these properties any way that you want.
Just as a reminder, if everyone on the call could just mute their calls for any background noise.
Other topics that come up, what qualifies for 1031, probably the most important on this screen is number one, clients have leases with at least 30 years remaining, including the renewal option. That is actually considered like-kind to something fee simple. So you can do that as a real estate 1031 exchange. The other one on this screen, number 3, we talked about already undivided interest in the property. So you could be a tenant in common owner. You could also be on title for a percentage of that property, but you're going to sell that and buy 100% of something else, or vice versa. You could be selling something locally and going into those for DST programs, for example. You're one percentage owner under, a trust situation. Timber rights, riparian rights, air rights, we've done all of those with 1031 exchanges. What you cannot do as a 1031 exchange is your primary residence, a second or vacation home that is strictly personal use. You have a second home, you probably consider it an investment, but it does not qualify for 1031. And then up here on the top left, right around 10 o'clock, partnership interest. That's probably the biggest thorn in our side for the Northeast for 1031 exchanges. We have many clients who are in multiple member LLCs or in partnerships, and now they want to go their separate ways when they sell the property. There's a lot of options they have to read through to determine the best structure for that in a 1031, and we'll talk about that a little bit at the end. So just to go back to the vacation and second homes for just a moment, the vacation and second homes are a little bit tricky. Prior to 2008, a lot of people were doing Section 1031 exchanges for their vacation homes. They were going up in value. They had put work into the property, improvements. They certainly considered it investment for their purposes. So they were doing 1031. But when the downturn started and the IRS was looking for funds to kind of kick back to help pay for other issues going on in the IRS world, they looked at the vacation and second home and said, this is not what we considered 1031 for. So really, if a vacation or second home is specifically personal use or enjoyment, where there's no rental, then it should be not a 1031 exchange. And these are just some of the court cases here that we won't talk too much about, but it just focuses on those facts.
Yeah, and Patty, you and I have talked about this before, and I don't know if you have a slide, but if someone uses that second home for 14 days or less, but the majority of the use is for income purposes, then it would qualify?
Right, yes, actually, we're going to go to that right in the next screen.
Fantastic.
Yep, thank you. Yep, so there it is. So as of 2008, this revenue procedure, to meet the safe harbor and be qualified as property for 1031, you as the taxpayer must have owned that property for at least 24 months prior to the sale. So the last 2 years, 365 times 2. In each of those last 2 years, you must have rented the property for at least 14 days per year. The number 3 here is really the kicker. So in number 3, even though you rented it for a few weeks each year, you want to be sure you declared that rental. That would be important. Some people don't do that, and if you're under 14 days, I don't really think you have to, or you're not required. But if you were thinking in the future of doing an exchange, you would definitely want to report that income. And number 3, the taxpayer's personal use in this property cannot have exceeded 14 days per year, or 10% of the total time rented in the last 2 years. So that's really the kicker factor here. If you rented it for 2 or 3 weeks a year, or maybe even just a few 6 or 8 weeks in the summer, have a seasonal property, then what happens is that you want to be sure that you're not using it more than 14 days per year otherwise. Going forward on the new property, the same happens. On the new purchase property, you want to be sure that you're only using it personally for at least 14 days in the following 2 years after purchase.
Again, if everyone could just have their phones on mute, just so we don't have any background noise.
So really, when someone gives us a call and wants to talk about the 1031 exchange, or we're trying to set up a structure and a plan to put this in place, usually my first questions revolve around, what are you selling? What type of property is it? I asked earlier, is it raw land, multifamily, apartment, commercial? And then I always want to know, what are the dollar value situations? When you're doing a 1031 exchange, it's important to know, what is your sale price? Do you have any financing to pay off, and about how much is that? And so what I will explain is that in a 1031 exchange, to be 100% tax deferred. Your goal is to, number one, buy new property of equal or greater value to your net sale price. So that's your sale price minus any of the standard closing costs that you would have. That's your net sale price, and your goal to buy on the other side replacement property should be equal or greater value to that magic number. Number two, you want to reinvest all the proceeds from the sale into the purchase of the new property. So as a qualified intermediary, we're assigning in and stepping into the transaction prior to the sale closing. Because, as Ken mentioned earlier, the seller cannot control the funds in between the sale and the purchase, we as the intermediary step in prior. We get a copy of the purchase and sale agreement, and we assign into that with the taxpayer to be able to receive their proceeds after closing. So the sale closing goes completely as normal. They pay their closing costs, attorney fees, tax stamps, commissions, any financing to pay off, etc. That bottom line net proceeds that would normally go back to the seller would instead get wired to us as the intermediary. We would have an account already in place for them because we've worked with you ahead of time. The account is open, the proceeds come in, so they're reinvesting all of the proceeds from the sale. And then going forward on the replacement side, their goal is to use all of those proceeds in the purchased properties as replacement, and then replace the debt. So on the buying side, you have equal or greater value, and you want to have equal or greater debt on the new properties. So you're either going to get new financing on the other side, be covered by the company in a DST situation, or you can bring in new cash. So if Aunt Millie died and left $300,000, and that was what you paid off on the other side, you can bring in new cash and not have to specifically have financing. But you have to match that debt that was paid off at the sale on the buying side. So as long as you have equal or greater value, equal or greater debt, and you roll all the proceeds, receiving nothing in cash, it's 100% tax deferred. Closing costs, there are some regulations on that, and so when I talk about that net sale price, it's because at tax time, your tax advisor, your CPA, is going to take a copy of the settlement statements from the closing. They're going to pull out all those normal closing costs from that, and what that's going to do is it's going to reduce your gain and not create boot for you. Items that do create boot, that you do have to worry about, is mostly on the buying side. First, if you have to pay for loan fees or points or anything that's not required for the closing specifically, those loan fees and points, more PMI insurance, those are all benefits to you, so those would be considered boot if used. Also, you want to remember that anytime you get cash back at either the sale or at the purchase, that is also considered boot. So boot is actually a taxable event. Anything that you're going to have to pay on with the gain, against the gain. So in a similar chart here, what we do is we talk about the 1031 exchange kind of in a graphic. The qualified intermediary is us down at the bottom. So IPX has been talking to the advisors, to the seller themselves, all along. We open an exchange account with that purchase and sale agreement. We, as I mentioned, do an assignment. We assign into the P&S. We prepare an exchange agreement. We need a W-9 for the bank account, all the know your customer requirements. So we have a document package that's required to be signed and returned to us prior to the sale closing. We also give closing and wire instructions. So our office, IPX, always works with the settlement agent, the closing attorney or title company, to be sure they know it's an exchange. That sale goes as normal. The deed goes directly to the buyer, but the proceeds, as I mentioned earlier, instead get wired to the intermediary and get deposited into the client's exchange account. Something to really note with IPX, a big security factor. We've been in business for over 30 years, and we have never commingled the funds. So every single taxpayer that we have in the country that we open up a 1031 exchange account for has their very own escrow account opened, bank account. We don't invest the funds. You can't say, oh, put it in my so-and-so investment account. It's getting a better interest rate. We are not allowed to do that, nor will we, because then you're actually opening yourself up for some concern in whether the proceeds will be there and fully available when necessary. So we hold the funds in a segregated account. The client has a W-9. It's opened under their tax ID number. We are just the manager of the account because the 1031 tax code says we need to be as the neutral third party. The other thing to remember that's special about our company and why we do this is because if creditors or anybody ever came at our company, or our parent company, they cannot get at your funds or your client's funds because they're under their name and their tax ID number or EIN number. The timeline. This is my other very important conversation when we're talking about the exchange and making plans to set this up. The timelines for the 1031 are very quick. So day 0 on the left here of that bar graph, day 0 is the day of the sale closing, the date that benefits and burdens are transferred. It is not the date that you make an offer. It is not the date you sign a purchase and sale. So on the sale closing date, we open the account, the funds are coming to us. You as the seller now have 45 calendar days to identify to us in writing on our form what property or properties you plan to purchase. You have a full 180 days to close of the exchange out, which means purchase the new property, use all the funds. But that first 45 days is crucial. There are no extensions. So we send out a letter once the sale has happened, or how much money we're holding. This is your closing date, day 45. Please be sure to get this form into us as soon as possible. So when you're planning ahead for your exchange, you really should be starting to look at what properties you might purchase even before the sale closing, because that 45 days goes very, very fast. We'll talk about some of the options for how you identify properties, but sometimes people already have a purchase and sale for what they're selling and what they're buying before they call us. Sometimes they don't know what they're going to buy and they have that 45 days. The DST programs are wonderful because they seem to always have something in the queue. So you should always be talking to your advisor prior to the sale closing just to see what's available, how it works, and get comfortable with what the options are for that. So when you're in your 45-day window, it's more just a matter of paperwork and getting it all done. You have till day 180 to close. Any property that you have not closed on by day 180, if we still are holding funds in the exchange account, those funds will be returned to you and considered boot or taxable. There are no extensions. I tell that to everyone all the time. Of course, down in the bottom right corner, there is one extension. If your property or your primary residence is in a federally declared disaster area, then you can apply online through the IRS directly for a 120-day extension, not just for 1031, but for other tax deadlines that would be looming for you. We assume we're not going to have any more federal disasters. We try not to, so I just tell people there are no extensions. You identify a couple of different ways. The first way is considered the 3-property rule, and certainly the most common. You can identify, or meaning list to us on our form in writing, up to 3 properties that you plan to purchase, even if you may purchase only one. Number 2 and number 3 might be backups for you, or you might sell one and buy 2 or 3. That's your plan. You're going to divert some money in the exchange account to number 1. You're going to divert some money to replacement property number 2.
And Patty, in some of the DST programs, they represent not just a single property, but maybe a portfolio of properties. So can you just comment on how you identify multiple properties in a portfolio?
Sure. So normally speaking, the DST properties may have 3, 5, 6 properties, whatever they are, generally more than 3. And so in a DST identification, you would use this 200% rule. So the DST might be one name, DST, multifamily, Boston, Massachusetts. It might be the name of it, but it may have 3 or 4 or 5 properties within it, within that portfolio. So what you have to do is you have to identify the percentage of ownership of each of those property addresses, each of those legal addresses within the DST. So you would use the 200% rule for that. The 95% exception rule is not utilized too much. You either usually identify 3 properties of unlimited value, or you use the 200% rule, which says that you identify more than 3 properties, but the value cannot exceed twice what you sold. So that 45-day timeline, as you can imagine, is very tricky for people. A lot of times they are looking to buy back, and it's easy in an area that was easy to sell, but not so easy to find properties to purchase. Boston and Greater Boston would be a wonderful example of that. The properties are gone even before they hit the MLS. There's agreements made behind the scenes, and that's working out of Boston now. That's Somerville, Medford, Quincy, Braintree. A lot of the outlying areas, the properties are moving very fast. So for that reason, some people might consider a reverse exchange. People also might consider a reverse exchange if you had a property to sell, but you were not planning on selling it. But all of a sudden a new property comes along on the market. You've been waiting for that property, or you really are interested, and you have to, for whatever reason, close and purchase the new property before you've sold the old property. That case would also call for a reverse exchange. So when you have to take title to the new property first, the IRS does not allow you as the taxpayer to be on title to both properties at the same time. It requires a third-party parking event, which means that we as the intermediary become an accommodation title holder. We set up a single-member LLC, and we step in and take title to the new property until the other one can be sold. In that scenario, what happens is an EAT, or an exchange accommodation title holder, has to set up usually a single-member LLC. We step in, take title to the new property on the client's behalf, and then we park it with us. They have 45 days to identify what they're going to sell, and they have 180 days to sell that property, come off title, and take title to the new one that we've been parking for them. So the big question in a reverse exchange is, how are you going to get the funds to buy the new one if you haven't sold the other one yet? Maybe you have the cash from somewhere and that's easy. You're just going to have line of credit. You have equity other places that you can pull. Maybe you have to get financing from a lender. If you have to get financing from a lender, then they have to also be on board with the fact that some entity is taking title to the replacement. That's a really big deal for them because they're underwriting you as a taxpayer, they're pulling all your credentials, etc. And then all of a sudden they hear, what? Some other company's single-member LLC is taking title? That makes them very nervous. So we really have, usually it's a good 2 to 3 week window at least of conversation back and forth and a planning stage. You never want to sign any financial lending documents until you are sure that they are comfortable with the 1031. Other considerations that you want to have is any financing that the lender has with us, we're listed on the note and mortgage. So it's going to be non-recourse and fully assumable back to the client at the end. We don't want you to have to redo your whole financing a second time. Insurance policy, we have minimums that we need to be sure are carried while we're on title. Our LLC has to be an additional insured. For any properties larger than a 4-family multi, we require an environmental phase 1 summary to review, right? If you remember, a lot of things happen under the ground where no one sees. We want to be sure that if we're in the chain of title, that it's a safe property and not environmentally affected. Some states like Pennsylvania and New Hampshire, you may have double transfer tax stamps. That's an additional cost. You may have some additional attorney or title company fees involved. There may be some additional title insurance premiums involved as well. So a lot of times people will call and say, oh, I heard I can just do it in reverse. I'm closing next week on the purchase. Not so simple. You really need to take the time to walk it through. So we really need a few weeks notice for that. So on to the topic of vesting. This is another important discussion in 1031 that you have sooner rather than later in your transaction. When I'm on the call with somebody asking what they're selling, what their price is, etc., I'm also saying, how do you own the property? How are you on title? So if they say, oh, it's under my individual name, that's fine. If they say, oh, I'm in a partnership or my partner and I own it, we have to take a step back. Well, how are you and your partner related? Are you related, because you're in a true partnership? Are you just partners in crime? Is it by marriage? You really need to figure all of that out to determine how you're going to take title in the exchange. So in a 1031 exchange, the same entity that sells on the left column must be the same taxpayer entity that buys on the right. So if you sell as your individual name under your Social Security number, you buy the same way. AB Partnership sells, AB Partnership buys. Acme Corporation sells, Acme Corporation buys. Any entity can do an exchange. It's totally fine for LLCs, corporations, partnerships, trusts, etc. But the same underlying taxpayer ID number that when you sell has to be the same as when you buy. So sometimes people have that confused. How they report on their tax return is really not how they're on title. A lot of times we as the intermediary are the first ones to discover the issue because a purchase and sale comes in, the attorney or realtor who did the P&S used the deed to list the seller name, but when you go to fill out a W-9 for us, you start listing a partnership or another entity, and that's where the misunderstanding gets shown. Its true colors.
And Patty, we've had situations where a partnership existed, one partner wanted to do an exchange, the other wanted to take the cash, pay the taxes, and we've talked through this before, that they'd have to dissolve that partnership before any sort of sale or exchange could take place.
That's true, yes, and that's another reason to kind of sooner rather than later start talking with the intermediary and let us get involved. Because there really are some issues to that. We'll talk about a few partnership options and a few screens. But if you're on title with somebody, you have a client who's in a partnership with an LLC, and you're starting to hear rumblings, like they maybe want to sell, maybe they want to go their separate ways, even if it's not until the next tax year, now is the time to figure that out and try and take some steps that are more conservative now to be set up for later. And again, just a repeat, I mentioned this already, any entity can do an exchange. There are some exceptions, so maybe you're in a trust that's passed through to your Social Security number when you sell, but when you go to buy, the lender might not allow you to take title in the trust, so as long as the underlying tax ID number is the same, that's fine. And then over on the right, under the single asset entities, the single member LLC is probably the most common. A lot of people have owned investment property where they've been leasing the property out for years under their own individual name. It's a little bit nerve-wracking, I think, for advisors because they think there's a lot of liability there. So if you sell under John Smith in your Social Security number, you could actually create John Smith Single Member LLC to have the liability protection, but it's a disregarded entity, so it's still a pass-through to your Social Security number. Most of the people on the call are from the Northeast here. There are 9 community property states that have a little bit different rules as far as husband and wife situations. I don't usually talk about that too much because, again, it's mostly on a partnership. So, as Kent mentioned, there are some partnership issues that we like to talk about. Scenario number 1, a partnership owns property and they want to sell. Some of the partners want to engage in an exchange to defer the taxes, and some want to cash out. Scenario number 2, a partnership owns property and wants to sell it. They all want to do an exchange, but they want to go on and do separate exchanges. They really don't want to stick together anymore for whatever reason, and that happens more often than not. So part of the problem is exactly what I was mentioning about the same underlying tax ID number. If that partnership has been filing a return every year and has 3 partners and it sends a K-1 to all the partners, these partners think, well, I report my third, but the reality is that the IRS thinks the partnership is the taxpayer and the owner. It doesn't really matter to them right now who the underlying K-1 recipients are. So the partnership or the multiple member LLC is really the taxpayer, and that's what the problem is. So you might see what they call a drop and swap, and the reality is that the IRS even calls it that, so they know it exists. So in a partnership with 3 members, they all want to go their separate ways. Maybe one wants to cash out, maybe not, but they definitely don't want to stick together, and they want to dissolve that partnership and close it out. You might have the partnership drop down the real estate property to tenant in common, so they're actually transferring it on a deed from partnership to John, Steve, and Dave as tenant in common owners. Now they each own a third. So when they go to sell to that ultimate buyer, they can each take their third and do what they want. They can have separate exchanges, one can cash out. The problem with that is that the IRS looks at them as different taxpayers. They've been reporting the property under that corporate tax ID number, the EIN, all those years, and now when they go to sell, the settlement agent is going to report the sale under their TINs, their social security numbers. Even though they're the same person they were yesterday, their tax numbers don't match to the IRS. So if the IRS ever looked into it, saw it, and questioned it, it would really be up to you and your tax advisors to be, explain, well, we had to dissolve to go our separate ways, to drop down to go our separate ways. This is the only way the exchange rules will let us, and you have to state your case and hope you're fine. There is the option to swap and then drop, which means if you're amiable enough to stick together because you don't want to rock the boat, you want to be more conservative on your 1031 exchange, you might sell as the partnership, do the exchange, but buy 3 different properties, one that John likes, one that Steve likes, and one that Dave likes. It's a little bit trickier. It's more like a partnership division. Someone owns 98% of one, each owns 1% of the others. A little bit more technical in nature, not always easy to do, but I've had family sibling relationships where that's worked out okay, and some partners who are fine sticking together for a while. You file a partnership, their Form 1065 is used, and it asks the taxpayer these 2 questions. Have they distributed property in a 1031 exchange or contributed to another entity? So these questions are pretty important. And that's where the drop and swap kind of comes to light for the IRS. So when you say, well, how are they going to know? That's probably how they're going to know. California has really, really come down hard on these. They're looking at this as a revenue raiser. If they see that there's a drop and swap the day before or the morning of the closing, which is most often when it happens, they can go back and try to discredit your exchange. And then it's up to you to prove form over function, and you need some advisors on your side. New York has also started in on this path as well. So really, it's definitely not the most conservative approach, but partnership interests you really want to walk through with your tax advisors sooner rather than later. And you can roll through those when we send out this PowerPoint. You can look at these more clearly. The one thing that might help for the partnership is this technical termination. Under the tax laws that came into existence on January 1st this year, it used to be if you had 2 partners, you had to terminate the partnership and definitely had to do a drop and swap. There were no choices. But now, if you have one partner and they own 50% and they want to do an exchange, they could actually bring in somebody else, bring in your spouse, bring in a sibling, bring in another person to bring into that partnership to keep it afloat. And then the other cash-out partner can take their funds and pay the tax. So this new technical termination rule that came into existence is actually helpful to those doing exchanges and wanting to go their separate ways. Just a final point, related party issues. Anyone who's doing a related party swap, where 2 related entities or family members are swapping property with each other, they have to hold the new property for 2 full calendar years. If one sells within 2 years, both exchanges fail. The more common related party exchange is where you're selling to an unrelated person and you want to buy from your parents, or you want to buy from a property that's been in the family for generations. It does not matter whether it's being sold for fair market value. It doesn't matter that it's going to be held for investment or business or rental use. The fact that you're buying the replacement from a related party or a related entity will disqualify you unless that related party is also doing an exchange, which hardly ever happens. So just a little warning about related party issues. I'm going to turn it back over to Kent, and we'll do some Q&A.
Fantastic. Thank you, Patty. So as we mentioned, if you have any questions, if you want to include those in the question box, we'll try to go through a few of those. So the first question we have here is, when should the investment property owner get a QI or qualified intermediary involved in the 1031 process?
So that's a great question. Certainly there are plenty of times where people don't know that they're doing an exchange. They don't even know that there's an option. They've already signed a purchase and sale agreement and are coming up on the closing. we can set the exchange up a week or so before the closing, but that's not fun for anyone, not fun for the QI, and not fun for the taxpayer selling. There's a lot of paperwork involved. The closing attorneys have to be involved, or title companies. So really what I would say is if you're thinking of selling, you should just give us a call, let us get you some information, so you can start planning. As soon as you have a buyer in place with a purchase and sale agreement, that's definitely the time to get us involved.
All right, so thank you. The next question is, unlike a straight 1031 exchange or up and down REIT, are you able to do a 1031 out of a DST upon liquidation?
Yes, so if you're in a DST program right now, that has qualified for the 1031 exchange under that revenue procedure. So you have a beneficial interest of ownership for your percentage in the DST. So later on when the DST decides as a unit to sell that property, we would set up another 1031 exchange for your percentage. You're a DST owner under your entity, and you could go on and do another exchange, go into another DST that's available.
Or a physical property asset.
Or a physical property asset, either one. So that's certainly fine.
Excellent. And then just to be clear on the dollar value rule, the seller would not have a full tax deferral if they purchase replacement property that is just equal to the cash sales proceeds or equal to the gain.
Yeah, that's a big point because a lot of people, even some advisors, are a little confused on that. So when your goal is to buy new investment property, some people think, well, I only have to buy something equal to the cash that comes out of the sale closing. Or I only have to buy something equal to my gain. And those are both incorrect. So you definitely calculate what is your gain, what is your adjusted basis with your tax advisor, and you set that gain number aside. And so say, for example, that your gain is $900,000 when you go to sell. But now, later on the other side, we'll use that example from the beginning, you're selling for $1 million. If you say, well, I'm only going to buy something for $800,000 on the purchase side, you're not buying equal or greater value. You're buying down in value. You sold for $1 million, you're buying for $800,000. We'll do all round number, easy math examples. So that $200,000 difference is boot, taxable. So you would go back at your gain and say, okay, well, I had $900,000 of gain, but in my exchange calculations, I have $200,000 of boot because I went down in value. So of that $900,000 gain, I'm going to pay tax on $200,000, and I'm going to defer tax on $700,000. So it's a partial exchange. So people just need to know that when you're doing an exchange, your goal is to buy equal or greater value to your net sale price, which is your sale price minus the closing cost.
And then the last question is, what is the typical income generated off of a DST, and what is the typical life expectancy or shelf life of a DST program? I would say that the answer to that is right now in the current market environment, you're looking at between 5 to 6% income streams to start, and typically most of those have rent escalators that over the typical lifespan of 7 to 10 years would be typical for most DSTs, and again, it depends upon sponsor and depends upon program. That income stream would escalate over that life expectancy, and then as Patty mentioned earlier, at the close of that DST, you'd also participate in any potential gains and would have the right to do another exchange into either another DST or into physical property at the termination of that program. With that, we're kind of coming up to the top of our call. I don't see any other questions. As we mentioned, we did record this. We'll be distributing. If you have any additional questions, our contact information is on the screen. And we really appreciate everyone taking the time to join us for today's call. Thank you.
Thank you.